Welcome back to another episode of Multifamily AP 360. And today's our guest is Travis Watts from Ashcroft Capital. Welcome back, Travis. You came episode 39. You are one of the early guests. And thank you for coming back after 3.5, 4 years.
Yeah, you're very welcome. Thanks for having me back on the show.
Awesome. And a little bit about Travis. Travis Watts is a full-time limited partner investor and the director of investor development at Ashcroft Capital. He dedicates his time to educating investors who are looking to be hands-off when it comes to real estate investing. So with that, Travis, so you want to add anything that, you did like last 4 years from, passive investor point of view or personal side, anything else?
Yeah, well, I guess I would start with saying what hasn't changed over the last 4 years. We were talking about 2020, the onset of the pandemic, pre-inflation, pre-interest rate hike cycles, all that good stuff. So it's really been a roller coaster, and I'd love to kind of dive into what's changed in the environment, both for GPs and LPs, and kind of what I see as the opportunity here in 2024 as we're speaking mid-year right now.
Awesome. Absolutely. Thank you very much. So you're also very like active passive investors. You did like 50 plus deals as a passive investor. Share us like some lessons learned from, as a passive investor.
Sure. Yeah. I've lost track of the count now as an LP. Quick background for anyone that's not familiar. I started with single family homes, flips, vacation rentals, all that good stuff. I ran that business model for about 6.5 years till I burned out. And I transitioned to becoming a limited partner in other people's deals and syndications. So that was in 2015. And when I say I'm a full-time limited partner investor, what I mean is everything in my portfolio, I'm a hands-off passive income investor. So I don't own any individual rentals. I'm not a general partner. I'm not a co-GP or capital raiser. I'm just an LP in other people's deals. So to your point, a lot's changed over 50 plus deals. I would say the first thing is, as we enter into market cycles like we've experienced over the last couple years and markets go down, which, we have to be aware that they do and they always will. As the saying goes, the bull takes the stairs and the bear jumps out the window, meaning that it takes a long time to develop a bull market in an uptrending market, but bear markets are sharp and fast. And that's exactly what we've experienced since the Fed came in early 22 to start increasing interest rates. That put the whole commercial real estate sector in a bit of a tailspin. And it's because of the debt structure that's put on these types of deals, right? It's often short term. There's a lot of floating rate. There's a lot of bridge loans. There's a lot of 1 year, 2 year, 3 year, 4 year, 5 year kind of debt. So it's not like single family homes where you might have a 30-year fixed rate mortgage, hopefully locked in at a low interest rate, which most people have nationwide at this point. So a lot of people, the first lesson to answer your question would be to check in with your psychology, because the natural human instinct, whether we're talking about the stock market or the real estate market, when things go bad or get scary, is to look for the exits. It's to sit on the sidelines. It's to quit being active and just wait and see. And I think that's a huge mistake, because right now we're seeing discounts in the commercial space we haven't seen in nearly 15 years after the Great Recession. We've been buying multifamily complexes at about 20 to 30% discounts relative to 2021 pricing. So check in with your psychology. Are you a long-term investor? Do you subscribe to the belief of dollar cost average year over year? Do you subscribe to the belief of buy the dip? When prices come down, risk comes down. When prices go up, risk goes up, as Warren Buffett likes to point out. The second thing I would say is that I learned this lesson early on, and it's betting on appreciation solely is really not a good strategy, because it's largely out of our hands and something that we've all just witnessed over the last couple of years. If you were thinking as a limited partner or a GP, I'm going to get in this deal in 2021 and we're going to double our money in 3 years, is probably not happening. So hopefully some of those deals had an element of cash flow, tax advantages, other ways that you could potentially profit throughout. So I got very nervous early on doing fix and flips because I got to realize that it was really the market that was helping me out. And if the market had been flat or in a decline when I was doing that model, I would have lost money on numerous deals. So as much as I thought I was, doing great and I was this expert, I really wasn't. It was really the market and just market conditions. So the third thing I would say that I've learned is just to diversify. There's so many ways in the commercial space alone that you can diversify. Most people think of diversification like, oh, I got some stocks and I got some real estate and I got some bonds and some mutual funds, maybe an annuity. That's fine. But if we zoom into commercial, which I'm primarily invested in, you could be invested in multifamily apartments, self-storage, mobile home parks, car washes, note lending, hospitality, industrial, the list goes on and on. There's lots of different sectors. There's lots of different geographies, and there's different types of business plans, different types of debt structure. So at any given time, when I look at my portfolio as a whole, I have deals that are underperforming, I have deals that are outperforming, and I have the vast majority somewhere in the middle about it expectations. So 3 things to think about. And most importantly, when it comes to commercial right now, I think a lot of us are tuning in a lot more to the debt structure that's being put on these deals and the amount of leverage that's being used. Because the pain point for so many is that 2021 was, ultra low interest rates and ultra high pricing. And now that's reversed, right? Values are down and interest rates are up. So it's kind of a tough scenario to make the numbers work. We're seeing a lot of pause distributions, capital calls, in some cases foreclosures. So it's not all good news out there as to what's happened, but it certainly has created this opportunistic time in 24 before we start to rebound and kick back into the recovery. It may be a very short-lived window. I don't know, 6 months, 12 months. It's going to be very short-lived, though, before these deals start getting scooped up, and then we're back to a supply and demand imbalance.
Awesome. Thank you very much. Thank you for sharing that. So based on your experience, like more than 50 plus deals as a passive investor, some are excellent returns, some are, not good, some are like in between, right? So when some deals went well, so what are some patterns or some common trends?
Some common trends on deals that have gone well. Is that
Yeah.
your question?
Yeah.
So I'll give you an example here. The deals that I invest, I'll use 2021 as the example because of what I pointed out. Really low interest rates, all-time high pricing. So the deals that I went in 21, and I invest with all kinds of operators, not just Ashcroft Capital. The deals that had the floating rate loans or the interest rate caps, combined with floating rate, a lot of them have suffered from being able to distribute the cash flow as projected. Because if you go back to the data of December of 21, and this is after the Fed meeting, the projection was the Fed projected they would increase rates, the federal funds rate, from 0 to about 2.5%. The reality is they took it to 5.25 to 5.5. So they went twice as aggressive as anyone could have forecasted. And some of these interest rate caps went up 10x in price. So that takes a lot of capital and a lot of strategy to keep those deals alive. Again, that's why we're seeing some capital calls, reduced distributions, pause distributions, things like that. The deals I went in 21 with fixed rate debt that was longer term, 7 to 10 year debt, let's say, are still performing as good as they were. I mean, better than they were in 21, because every year the rents are still trending up. In the case of the deals that I've done, there's no need to have to sell right now at a discount. There's no need to have to put a new loan or to adjust the debt. So we're locked into a 3% loan, not needing to sell, and the performance and the fundamentals remain very strong on the assets in terms of occupancy and collection. So again, major lesson learned, debt structure, and to always know that a projection, whether it's coming from a GP or a projection coming from Bloomberg or Morningstar or the Fed themselves or the government, is just merely that. It's a projection, not a promise or guarantee. So I think we're all looking at ways to kind of protect ourselves moving forward and be a little less optimistic in certain aspects of the business plan and be a little more conservative for real this time.
Yeah, very good point. So at the same time, like, would you also share some patterns or some trends, deals that didn't go well? You covered some of the other points there in previous answer. So
Yeah.
we elaborate on that.
Yeah, exactly. Okay, so let's create a new one here as far as a trend on things not going well. I think we are now entering a different era in the syndication space. So again, I got started in 2015, so I can speak to that through, let's call it 2020, right before the pandemic. So I'll give you that time frame. It was this business model was gaining massive popularity. Conferences, books, masterminds. I mean, it was growing. All these boot camps people would go to, new people entering the space left and right, week by week, just thousands and thousands of people getting into the business from scratch, which is all fine and well when the markets are going up and things are working out, just like with my fix and flips back in the day. Now, what we're finding is you're no longer able, in most cases, to find that 1980s or that 1990s product that has not been touched in 15 or 20 years, meaning you get to do value add and turn all these units and get these 200, 300 a month rent bumps over about a 3-year period. These deals have been bought up. These deals have been turned. And so now it's hard to find 100% value add opportunity, and you don't have the market, at least not as of right now, working in your favor. So it's come down to a new era of how good are you as an operator? Can you actually and effectively and efficiently operate these properties, still gain rent bumps in the process, do really good marketing, keep your occupancy and collections at very high levels, not have to give out too many concessions, this kind of stuff. So we're really seeing who's in this business for the long term, who are the best in class operators. And there's been a lot of shakeout over the last couple of years.
Awesome. Thank you. Yeah, very, very good point there. Like, you need to be very, very efficient, in the current market, right? So some markets, like, because of a lot of supply, rents are stable or, even negative also, right? So you need to be very, very effective to increase NOI. Yeah. Thank you.
Yeah,
Yeah.
you bet. Yeah, you're not seeing that, automatic 200 a month rent bumps. Back in 2021, the market went up so fast and so strong. You could have literally just bought a property in 2020 and been up, 20, 25% the next year without having to do really anything. So that's certainly not the environment we're in right now.
Yeah, absolutely. Thank you. So based on your experience till date, like, and also what you saw in the last few years, so what kind of strategies or principles do you adhere when selecting, passive investing opportunities?
I always recommend to people that you start with yourself. So what are your goals? What are you trying to achieve? Limited partners have a lot of different goals, but they kind of come down to, 3 to 5 categories. Some people are looking for tax advantages to offset other income. Some people are looking for cash flow income streams to scale up their income without having to be more active. Some people are looking for equity appreciation. Some people just like the fact that they can invest in a tangible, hard asset as compared to a digital asset like stocks. Start with yourself, figure out what your goals are and what you're trying to achieve and what your time frames are, all that good stuff. Then look down to the operator. I would say the operator is, you bet on the jockey, not the horse. That's my opinion. So, you can have a great deal in a great market. I've invested in deals like this, but the operator just completely flopped on the business plan, right? They intended to turn 300 units. They ended up turning like 25. They hired the wrong property manager. They had to fire them multiple times. There was a lawsuit and litigation in one of my cases. It just, you got to have a competent operator that knows what they're doing. Then you got to look at the market. So I love that there's so much free data out there from CoStar and Marcus and Millichap and Urban Land Institute and US Census and the U-Haul statistics. There's so much free info that gives you hints or clarity into which markets are growing and expanding and are expected to outpace the national average. Those are markets I look to invest in because markets have a huge impact on your bottom line. Third, you want to actually evaluate, of course, the deal. But the mistake that I made early on was focusing way too much on the deal in all the different aspects and not really paying attention to who was going to execute the business plan and what market it was located in. That was a really big mistake. So from a deal perspective, you want to look at, again, how many people are moving there, what kind of jobs are in the area, what kind of diversification of employment, what the school ratings are, all kinds of stuff, average incomes, average home prices. I mean, that could go on and on. There's probably 150 line items that we evaluate when we look at surrounding areas to the deal. And I've been a big fan of Class B and Class A properties. I've just had a lot less issues in my own experience investing in that type of sector. Class A being the newest, nicest properties in the market. Class B being, 20 to 30 years old, relatively speaking. And then C and D are below that. And with the C and D, I've just had, in my experience, more issues pop up with the residents, the tenants, the collection as we went through COVID, stuff like that. So I like taking something older, pre-existing, cash flow positive on day one, and enhancing it to its highest and best potential, and then selling it, and then moving the money into another value add opportunity to execute the same business model again.
Yeah. So before expanding onto that, so we can find, we can get the information about market and deal, but how to or where to find good operators?
Where to find, yeah, that's a good one. So I've always joked when I speak at conferences and podcasts, like, I wish there was like a Yelp, right? Where you could just go to this website and say, hey, show me all the 5 out of 5 operators. I don't want to look at anything else, but that just doesn't exist. There's been numerous groups that have tried to create something similar, but it just kind of lacks the infrastructure, the volume, the reviews, things like that. So how I've gone about it is, and I'm a person, by the way, started out not even knowing what a syndication was, not even knowing what a general partner meant in 2014. And then in 2015, getting started in my very first syndication. And I started with word of mouth referrals through a real estate meetup group that was in my local market, just asking people, do you know any syndicators that are around here? I started investing locally first. I don't necessarily recommend that. There's no real advantage to it. I thought there might be. And then I started going to these bigger conferences, and I started joining these forums and these groups online. I'll just name drop one as like Bigger Pockets. And you can start to seek out who's in the industry and who's who, and come to find after, 3 to 5 years of this kind of research and networking, it's kind of a who's who, like everybody kind of knows everybody. It's a small world out there in the syndication space, relatively speaking. So the other thing I would say is mentors have changed my life just through and through wholeheartedly. Some of the biggest changes I've ever seen, including investing in syndications, really came from 2 people that were already doing it for about 20 years plus. And they introduced me to the concept, and they sat there for about 30 minutes to help me understand what it is, how it works, and then share some of their case studies and experience with it. So find somebody that is doing what you want to do successfully, and you can kind of mimic their strategy, or at least they can point you in the right direction. And that can cut the learning curve by weeks, months, even years in some cases.
Yeah, thank you. Thank you very much. Very good points. So coming back to so from Ashcroft point of view, what kind of value add strategies or, different strategies or vertical integration strategies Ashcroft implementing to, reduce costs or increasing revenue, increasing overall NOI?
Yeah, exactly. So NOI, I'm glad you brought that up, is net operating income. Okay. So one of the most important metrics to understand in commercial real estate is the net operating income. The formula for those listening, if you're not familiar, is you take the net operating income, which is basically the income after the, debt expenses, some, that kind of stuff. Everyone's going to have a different debt structure. So NOI divided by the cap rate or capitalization rate, that's going to vary by market, equals the value. So you can kind of get a feel for how good of a value you're getting or what the value should be on a property if you just run that NOI divided by cap rate equals value. So NOI is the name of the game in commercial. This is why I really wanted to transition to commercial investing instead of single family. Because if I had a single family home and I was renting it out, and I had the best tenant in the world, and they were paying above market rents, and they were paying on time every single month, and then I chose to sell the property, it really doesn't matter what the NOI is, because the next buyer might just be looking to move into that home as a primary residence, and they don't care about my tenant, and they don't care about the rent, and they don't care about any of that. They're looking at comparable sales and saying, here's our offer based on the comps. In commercial, you can take a property producing, let's say, $5 million a year, bump it up to $5.5, $6 million per year over time, and all of a sudden the valuation can increase at a crazy multiple, 20 to 30x the income. So this is what we do. We buy a property that's older, pre-existing, but outdated. Therefore, the rents are below the market level. Because of that, you got to think about it from a renter's perspective. It's like, okay, here's this old, outdated property that looks like 25 years ago, or here's this nice new property that offers all this cool stuff over here at a higher price. It makes sense that this one would be lower in rent, right? So we're buying those properties and we're making them compete with the newer, nicer product in the market. Maybe we're taking the gym and on all the equipment, and we're enhancing it to be like a modernized brand new gym so that it's comparable to that A-class property over there that also has new equipment and a new gym. We're adding, patio furniture and pool furniture and redoing the clubhouse and redoing the amenities and adding dog parks and kid play areas and maybe a splash pad. And we're adding all this cool stuff that new properties have that residents want, and therefore we can justify increasing our rents slightly higher, but still below that of something brand new. So that's basically value add as a business plan in a nutshell. And then as the rents have come up and the revenues come up, the NOI specifically, we're looking to sell the properties at a higher price than what we paid for them. And then either 1031 exchange with our investors, if that's your preferred tax strategy, or to cash out and just go into other deals or do whatever you want with the money. So I'm a person that tends to cash out and not 1031, but not advice for anybody, just my specific methodology on it. So that's what we do. And, right now is an incredible time because, for example, we're closing on an Orlando, Florida property that was built in 2021. So this is considered a Class A property, $97 million purchase price, 5.5 cap rate. If we go back to 2021 and look at a property like that, we would have been paying maybe $30 to $40 million more for that same type of property. But because interest rates came up and cap rates came up, everything changed, right? That deal would have probably traded at a 3% cap rate in 21, and now it's a 5.5. But if you look at the forward-looking projections, again, CoStar, Marcus and Millichap, lots of different sources out there, you'll see that cap rates are projected to come back down and compress, which is going to help boost valuations. Equally, interest rates are forecasted to come down in the coming years, which makes it more affordable for the next buyer, which means they can afford to pay a little bit more for these properties. So again, it's a very limited window of time and opportunity, but that's what I'm seeing here in 24. And that's what we're doing, is try to scooping up as many of these deals as we can before that window of opportunity closes.
Awesome. Thank you very much. So what are some advantages and disadvantages, challenges with, going with vertical integration?
Yeah, so vertical integration, just, in layman's terms, means that at very minimum, you manage your own properties. You could technically say you're vertically integrated if you have in-house property management. Now, for us, we waited until we hit scale as a company. We had over $1 billion under management before we went vertically integrated. Some groups do it right off the bat from day one, but we were outgrowing our third party, basically. We were comprising nearly 40% of their portfolio that they were managing. And we were just one company. They were managing lots of groups' deals. So they didn't have adequate infrastructure. We had some struggles with some folks they were hiring and who they were putting on our properties. There was lack of alignment of interest, let's say, because no one cares more about your deal than you, right? So all of these flags were coming up, and we said, okay, not only are we going to bring it in-house, manage our own properties, we're going to bring construction management in-house so that we don't have to rely on third-party contractors and all these supply chain issues and these markups and all this stuff. And we're going to bring our procurement process in-house, which is like buying materials for our properties. So we don't have to source everything locally. This came in 21, 22, when there was a lot of supply chain disruption happening because of the pandemic. So we built out these warehouses in Dallas. We buy direct from the manufacturer. They ship them from overseas to Texas. They truck them to our warehouses. We assemble these ready-to-go kits to send on site to our properties. And in these kits are things like light fixtures, ceiling fans, door handles, cabinet pulls, shower rods. It's the smaller stuff, but it's still a lot of the materials. And even down to like the nails, the screws, stuff like that. They get put in a big shipping crate, sent to the property right after we close it, usually to the back of the property in the parking lot where it's kind of not an eyesore for our residents. And then we have our in-house property management and construction team on site. They open up the crate, and there's all these individually boxed kits for unit 101, 102, 103, 104, probably enough for 20 to 50 apartments to get started with the renovation. So number one, that saves us about 30% on material costs compared to how we were doing things previously and compared to how a lot of our competitors do things. That increases the return on investment for investors. It's cut our turnaround time down to 14 to 21 days per unit as compared to roughly 30 days previously before we did this. And it's much more environmentally friendly because when we order light fixtures or shower rods, for example, we're getting hundreds or thousands packaged together in one box without all the colored cardboard packaging and the styrofoam and the plastic. So it's much more streamlined, much more efficient. And I'll give you a practical example of why and how this is so impactful, especially for a group, of our size. We've acquired over 21,000 units. Okay, so let's take a flush mount light as an example, which is nearly, there's multiple ones in every single unit of our properties. So a standard flush mount light you'd get at a local hardware store might be $20, $30, $40 depending. It's usually got two different light bulbs in there, usually sold separately. And then if you're installing that light, or let's say a resident accidentally breaks that light, the glass on it, what do? You have to go back to the local hardware store, buy a new one, a complete unit, light bulbs, etc., and replace it. Well, for us, because they're custom designed, they have one light bulb instead of two, which obviously cuts down a little bit on cost. They're LED, which is eco-friendly. And if that glass breaks, we actually have the parts and components on site to just replace the glass and not have to replace the entire light fixture. So that alone can save $20, $30 every time that occurs. And it's very little storage and overhead to have on site. So you times 10, 20, $30 by 21,000 units, and we're talking millions of dollars in savings. But again, we waited till we hit scale to be able to do a lot of this stuff. So effectively, we've created like our little mini Amazon for ourselves, which is pretty cool. So those are some things that I was talking about earlier that are operational efficiencies, right? Are you in this business as a true operator, and how are you creating value for investors, even if rents are flat, let's say, or you're not able to do the 100% value add like you were in years prior? There's still a lot of ways and creative avenues to create more net operating income and to save on the bottom line.
Yeah, awesome. Thank you. Thank you for sharing that. So what's your point, your view, or what do you see like next 18 to 24 from multifamily investment point of view?
Yeah. So again, I believe, and when I say I believe, this isn't about me and my opinion. I've been writing a report for 2 years that's free to the public. You can find it at ashcroftcapital.com. It's called a Market Insights Report. I do it every single quarter. We're about to release Q3 in a few months. I'm sorry, a couple of weeks. And I take all these sources of data and I compile it into like a 15-page report with very little commentary and opinions. It's just the facts. It's just what's happening. And so what do I see coming up in the next year or two is, again, this is an opportunity to buy the dip. It's an opportunity to dollar cost average. It's one of the best years we've seen over 15 years for valuations in the commercial space, about 25% discounts on multifamily. And again, we're buying a Class A building that's stabilized and cash flowing, whereas a few years ago it would have been 30 million plus more to purchase the same type of building. So the other thing to think about on top of what I've already covered is supply and demand. Obviously is a huge factor to real estate. It's something a lot of people have their eyes on. So the National Multifamily Housing Council has come out to say this year that we need to build approximately 4.3 million more apartment communities between now and 2035 just to keep up with the demand. And we're already seeing that even though all this new supply has been hitting the market this year and last year and maybe a little bit next year, it's getting absorbed at a rapid pace, the 8th largest absorption in US history. So that's really good metrics to think about. Meanwhile, new builders and new construction, if you go look at new permits, which I put in these reports every single quarter, they're scaled back about 40 to 50% on starting new development compared to years prior. So where does that put us in 5 years? You're able to get a discount now. You're going to have less supply in the future. You're going to be very thankful to be an owner if you're buying today. And then we look 5 years forward, and hopefully cap rates are lower, interest rates are lower, and all the rest. And the last thing I'll say, Rama, is that we've got the largest gap in US history right now between a new mortgage payment and apartment rent. It's about $1,000 per month, which is a really, really sizable gap for the average person. And as you know, with home ownership, that's the minimum payment you're going to make every month. That doesn't even include property tax and higher insurance and potentially having HOA fees and maintenance or special assessments. There's so many other factors to owning a home that makes it much more unaffordable. Not to mention, you need to have great credit, highly qualified, sizable down payments, and all the rest. So it really is making the case for why 2024 and 25 are ideal times to be a renter.
Yeah, absolutely. Thank you. Thank you again. So let's shift towards personal side. Any habits, any personal habits that are helping you to be successful, Travis?
Absolutely. Yeah, I would say that. So what I used to do is I would just wake up in the morning and just go super hard throughout the day. And I would usually burn out by about 3 p.m. because I just tried to pack it all in as much as I could at my max potential. I found that there's a lot more value to having balance in my life. And so, first of all, I don't wake up and start doing emails or check my phone or get right into it, right? I'll take 30 minutes to kind of have self time. If that means waking up 30 minutes earlier than you prefer to, I would recommend it. You can do meditation, you can do exercise, whatever, but get your mind kind of sorted out before you even begin the day. And then I start tackling usually the hardest project that I have on my plate for the day first. That's something from the book, The One Thing, Gary Keller. And from there, it just incrementally trickles down to the easy stuff by the evening, like catching up on emails and things like that, follow-up conversations, etc. But really taking breaks throughout the day, implementing exercise is kind of a new thing for me. I really ignored health for a long time, unfortunately, and I'm just circling around to paying a lot more attention to that now that we've had our firstborn son, and trying to be more present with him in the moment and thinking more about, being there physically for him as the years go on. So finding a balance, I say, in simplicity, not trying to overwork or overstress yourself, because it in my case, it's always led to burnout, including flipping homes back when.
Yeah, absolutely. Thank you. So any personal learning that played major role in your, growth or, in our life?
Mentors are huge. I know I already alluded to that, but if I think about the conferences I've attended, the books I've read, the podcasts I've tuned into, all these different things, self-education, mentors made it real. They were real people with real results that could really help guide me in the right way. As you know, you read a book sometimes, maybe it was published 10 years ago, you get to the end of it and you have all these questions. It's like, well, what about interest rates? What about the Fed? What about the election? What about, so like, it's hard to just read a book and have all the answers. You wish you could just reach out to the author in real time and say, hey, what's changed since you wrote the book? What do you recommend now? That's what a mentor is. They can speak to you in real time and say, well, this is what I see, and this is how I'm navigating it, and this is how it's different than before. Mentors are huge, and you don't have to pay for mentorship. I know a lot of people get scared away thinking, well, I got to join some, $30,000 coaching program, or, what. You don't. If you can find a way to add mutual value to someone else, most people, in my experience, are willing to give you their time. And even if you can't add much value to them, if you just ask for something reasonable, like, hey, would you mind if we just had a 15-minute phone call? I promise to keep it at 15 minutes. I've got these questions I'd love to ask you. Most people do want to help, and they are willing to help. So mentors can come in many forms, but just keep that in mind, because it's had a huge impact.
Awesome. So any one book that impacted you recently?
Oh, recently, so here's the thing. I've read a lot of self-help and how-to and nonfiction stuff. At night, I like to listen to biographies and autobiographies. Right now, I'm listening to the story of the Vanderbilts on Audible. It's narrated by Anderson Cooper. It's an inspiring story. It can help you realize and gain a broader perspective of what other people have gone through, how people came into success, what things, changed the trajectory of their life. So that's the one that I'm listening to right now, but I probably go through a book a month on average. But change it up. Again, back to the burnout conversation. There was a year I read 52 books in 1 year. That's a book per week. That was my goal. I did it, and I do not recommend it. It was way too much information. I did not retain, maybe 5-10% of what I read that year. And it's just too much, so break it up, a little bit of how to, take a little bit of action, and then try to get inspired, in whatever way works for you. And then maybe go back to the education, and then a little bit of action, and then back to the inspired. I try to rotate it and find that balance. So that's what's worked for me.
Yeah, awesome. Thank you again. Thank you. So how can listeners can connect with you, Travis?
I created a landing page that has most everything your listeners will probably want. It's ashcroftcapital.com/Travis. I put my calendar link out there to the world. I don't care if you're young or old, accredited, non-accredited, interested in Ashcroft or not. I'm happy to have a 15-minute conversation with anybody to help point you in the right direction or answer questions. Or I've got financial trackers, current offerings and opportunities, like our Orlando deal that we're doing right now, downloads to the newsletter that I referred to. There's a lot of stuff on there. So it's ashcroftcapital.com/Travis.
Awesome. Thank you very much, Travis. Again, it's great connecting with you and learning a lot of stuff from you.
Thank you, Rama. Thanks, everybody.
Awesome.